Hey there, welcome back to my channel, it's me the Mind Injector. Today we've got some jaw-dropping news from Tom Lee that could completely change how you see the stock market. His latest prediction for the S&P 500 is sending shockwaves through the financial world. And trust me, you won't want to miss what he just revealed. Before we continue, make sure to subscribe to stay ahead of the game with all the latest insights. Now, let's jump right into it because this update is huge. Tom Lee has always been a bold figure in the financial space. He is known for making big predictions, and while that puts him in the hot seat, he's been right more often than not. At the start of this year, when the S&P 500 was around 4,700, Tom made a bold call that caught a lot of people off guard. He predicted the index would rise by another 1,000 points by the end of 2024. People thought it was a stretch, but fast forward to today, and we've hit 5,700. He nailed it. Now, just recently, CNBC pressed Tom for an updated forecast. Initially, he held back, citing the uncertainty in the market. But now, something's changed, and Tom came back with a brand new prediction that could reshape your investment strategy. Let's cut straight to the clip so you can hear it from the man himself.
Bull market story still intact as Wall Street has largely avoided the seasonal weakness, as we were mentioning, of August and September, but a number of threats are looming, including, of course, the election 4 weeks away. Our next guest is looking past the headwinds and focusing on three tailwinds, including a dovish Fed, China's late stimulus push, and lots of cash on the sidelines. Let's bring in first CNBC contributor Tom Lee, co-founder and head of research with Fundstrat, and our very own Mike Santoli joining us as well. Tom, let me start with you. It was in April on this program that you said you thought the S&P 500 could close at 5,700, maybe even higher. Well, looky here. Look where it is today, right about 5,700. So the maybe higher part is still a part of your formula?
Yes, I think it's part of the formula because, bull markets are supported by strong fundamentals. And this is a case where not only has the economy survived extremely high interest rates, but the Fed is beginning to cut rates. And an economy that has sort of been languishing has been China. And now we have some stimulus and what looks like some bazooka policies that is supporting that region. And we have a lot of cash on the sidelines. So I think that this is a formula for stocks to do pretty well the next 3 to 12 months. And that's why we think that we would be well beyond 5,700 before year end.
Well, so Mike, Tom says tailwinds overpower headwinds here.
Yes, although I think you do have some offsets. And I think that even though the August and September, the advertised seasonal weakness didn't really show up in the terms of sustained downside, it did become a less rewarding market, right? You had more downside moves from that August 1st level than you had upside, at least during those 2 months. So I do think that reflects the fact that we have priced in a pretty decent scenario here. We're 21 times forward earnings on the S&P 500. I think a soft landing is pretty much what's underpinning that idea. That said, it's hard for the market to get into too much trouble when the Fed is easing into a resilient economy. And even though we're having to worry about maybe less Fed easing than we thought Thursday before we got this jobs report, I think that's a better formula. Economy holds up better. The only reason you'd worry about it is if you think the strong Friday jobs number was a head fake. And all of a sudden, it really was not representative of the economy being strong, and yet yields are higher, and yet oil's higher. We're benefiting from those things starting at very low points, under $70 crude, and then, 3.6 on the 10-year as a low recently. And so, therefore, the big violent vertical moves we've had in those areas have not really upended anything except maybe the housing stocks. But I do think, you have to be aware that we're 2 years into a bull market. That's often where it kind of flattens out and becomes a little bit less aggressive on the upside.
As our guest last week said, the third year is the hardest one often.
Has tended to be, yeah.
Tom, do you want to build on that and address what you should do with small caps here, why they've been so, actually, that's probably the one area we've seen the most weakness since the Fed hiked rates.
Yeah, small caps, they're within a few percentage points of an all-time high. And Mark Newton, our head of technical strategy, thinks we are still in an up move for small caps that just started recently. But yes, it's been disappointing. I think it's been especially disappointing because China and small caps historically are fairly highly correlated. And so we are seeing risk-on appetite increasing in some places. But I think it's just a matter of time. I think part of this is, between now and the next month, which is around Election Day, there's a lot for investors to digest. It's including oil prices, and the VIX is elevated. I think these are things that are hard for someone to say today, between now and early November, I want to be buying risk outright. So I think small caps still have good fundamentals. Earnings growth is accelerating. The median PE is 11 times, which is almost 7 turns lower than the S&P. So I think there's still the case to be made that small caps are starting a multi-year gain. It's just been very choppy.
As you look at oil, what would an interruption of Iranian oil supplies, which is really only 3%, as I understand it, of global output, what would an interruption of Iranian oil mean? Maybe not in economic terms, because it might not mean very much, but what it could mean psychologically to the market.
Well, markets don't like uncertainty, and oil is spiking not because of demand, but because of, like what you're pointing out, Tyler, the risk of a disruption. And, oil can move up quite a lot before it actually triggers the level of burden that causes a recession. That number is probably closer to $200 today, but it would be no fun for any consumer to see oil at 120 and gas prices more than double. So it's something that I think would be very painful for consumers just to see oil surge, and even if it's temporary.
There it is. Tom Lee is now predicting that the S&P 500 could soar well beyond 5,700 by the end of this year. Despite all the uncertainty swirling around right now, he's confident that the market still has plenty of room to run. So, what's driving his optimism? Tom points to several key factors. First, the economy has been surprisingly resilient in the face of rising interest rates. The Fed has started cutting rates, which creates a much more favorable environment for stocks. But here's the real kicker. There's still over $6 trillion in cash sitting on the sidelines, waiting to enter the market. Once that money flows in, we could see a significant rally that pushes the market even higher. Now, I know what you might be thinking. How can we be so sure when the market is facing so much uncertainty? It's a valid question. There's a lot of noise out there. Geopolitical tensions, the upcoming election, oil price spikes, but Tom isn't ignoring those risks. He's just looking at the bigger picture. In the short term, things are likely to stay volatile. The closer we get to the election, the more choppiness we're going to see in the market. Tom expects a bumpy ride over the next few weeks, but he's urging investors to stay focused on the long-term outlook. He believes that once the dust settles, especially after the election, we're likely to see a strong rally. Now, let's talk about how this market volatility could play to your advantage. Tom sees this potential pullback not as a threat, but as an opportunity. For those ready to act strategically, these dips can offer a great entry point into the market before it rebounds. With trillions of dollars in cash still waiting to be invested and rate cuts setting the stage for long-term growth, investors who remain patient and avoid knee-jerk reactions could find themselves in a prime position when the market begins its next upward swing. But that's not all. Let's talk small caps for a minute. Earlier this year, Tom predicted that small cap stocks would rally hard, but that hasn't panned out yet. He acknowledges that his timing was off, but he's doubling down to the idea that small caps are poised for a multi-year gain cycle. These stocks were hit hardest by the Fed's aggressive rate hikes, and now that rates are coming down, they stand to benefit the most. Tom believes that once the election uncertainty clears, small caps will begin to climb. Historically, small caps tend to outperform during periods of economic recovery and monetary easing. So, while the rally hasn't started yet, it's only a matter of time. Patience will be key, and for those willing to wait, small caps could present a massive opportunity. Now, let's shift gears for a moment and talk about oil. Rising oil prices are another major concern right now. With geopolitical tensions in the Middle East, oil has been climbing, and if it hits $120 a barrel, it could create serious pressure on the economy. Higher oil prices mean higher costs for consumers, and that could slow down growth. But Tom doesn't believe it will be enough to push us into recession, unless oil shoots up to $200, which he thinks is unlikely. So, while oil is something to watch, it's not enough to derail the market's long-term prospects. In fact, Tom's view is that the market fundamentals are still strong, and any short-term volatility should be seen as a buying opportunity. Before we get into the exciting details, let me introduce you to Moomoo Financial. If you open a brokerage account with Moomoo and deposit at least $1 using the link in the description, you'll get a chance to draw a free stock worth up to $2,000. But that's not all. If you make a net deposit of $100 or more, you'll receive not just one, but 5 free stocks worth up to $2,000 each. And if you're really serious about investing, you can deposit $1,000 or more and get a whopping 15 free stocks, bringing your potential earnings to a staggering $30,000. So, sign up now using the link in the description and get those free stocks. Now, let's get back to the video. Here's where you need to pay close attention. Tom Lee's overarching message is this: don't get distracted by the short-term noise. Yes, there's going to be volatility, and the market could pull back before the election. But once that uncertainty clears, the stage is set for a rally. With rate cuts, a resilient economy, and trillions in cash ready to flood the market, the conditions are there for a strong push higher. Let's quickly recap. Tom Lee is predicting that the S&P 500 will climb well beyond 5,700 by the end of the year. He's confident that the combination of a strong economy, Fed rate cuts, and sideline cash will fuel the next rally. Beyond the broader market, Tom also sees significant potential in small-cap stocks, which are poised for a multi-year gain cycle. While rising oil prices are a concern, they are unlikely to derail this growth. The key takeaway here is to stay patient and be ready to buy the dip if the market pulls back in the short term. This is it for this video, guys. Thanks for watching, and please make sure to subscribe, like, and leave a comment down below.